Welcome to Investor's Secret, and today we will be checking Warren Buffett and his top 6 rules of investing in the stock market.
You're going to be a lot better off owning productive assets over the next 50 years than you will be owning pieces of paper, or I'm going to throw in bitcoins.
We will include Warren Buffett's famous interviews across different platforms and what he thinks when investing in the stock market.
You don't want to get hung up on trying to make economic analysis, because you don't get rich doing that.
Now, without further ado, let's begin. Starting off, top 6, cash is trash.
Cash is always a bad investment. I mean, when people said cash is king a year ago, I mean, that's crazy. I mean, cash wasn't producing anything, and it was sure to go down in value over time. And then you always want to be sure you have enough. I mean, it's like oxygen. You want to be sure it's around, but you don't need to have excessive amounts of it around. And cash, we will always have enough cash around. But anytime we have surplus cash around, I'm unhappy. I mean, I would much rather have good businesses than cash. And we found a chance in the last year or thereabouts to deploy. We came in with something over $40 billion in cash, and we've got about $20 billion now, and we've had some earnings. So we put a lot of cash to work, and I like that. No, I'd much rather own a good business than have cash.
Now going to top 5. If you have to follow a company closely, you shouldn't own it.
Well, if you have to closely follow a company, you shouldn't own it.
Really?
No, I mean, if you buy a business, if you buy a farm, you go up and look, every couple of weeks to see how far the corn is up, and you worry too much about whether somebody says this is going to be a year of low prices because exports are being affected or anything like that. You buy a farm and you hold it for. I've got one farm that I bought in the 1980s, and my son runs it, but I've been there once, I mean, it doesn't grow faster if I go and stare at it. I can't cheer for it, more effort, or something like that. And I know there's going to be some years when prices are going to be good and some when the prices aren't going to be good. I know there's years when yields will be better than others. But about the farm.
Now top 4, macroeconomics do not matter.
I've been buying businesses and stocks for a lot of years, stocks for 71 years, and businesses for almost as long. And I've never really made a decision based on macro factors. If I find a business I like, I buy it. I mean, the first stock I bought was in the spring of 1942, and I will tell you the macro factors were not looking good. It was right after Pearl Harbor, and we were getting clobbered in the South Pacific, and the war did not look good. Now, I think almost every American thought we were going to win the war, but when I bought my first stock, I went in 100%. I spent all my $120. I was not doing it based on headlines. I was doing it based on what I was getting for my money.
Getting to top 3, read 5 to 6 hours a day.
I just read and read and read. I probably read 5 to 6 hours a day. I don't read as fast now as when I was younger, but I read 5 daily newspapers. I read a fair number of magazines. I read 10Ks, I read annual reports, and I read a lot of other things too. So I've always enjoyed reading. I love reading biographies, for example.
And you process information very quickly.
Well, I have some filters in my mind. So if somebody calls me about an investment in a business or an investment in securities, I usually know in 2 or 3 minutes whether I have an interest. And I don't waste any time with the ones in which I don't have an interest. I always worry a little bit about even appearing rude, because I can tell very, very, very quickly whether it's going to be something that's will lead to something, or whether it's just a half an hour, or 2 hours of chatter.
Now we are in top 2. Ensure that you will not lose anything.
Warren, how do you determine what you think is a fair price to pay for the business?
It's a tough thing to decide, but I don't want to buy into any business I'm not terribly sure of. So if I'm terribly sure of it, it probably isn't going to offer incredible returns. I mean, why should something that is essentially a cinch to do well offer you 40% a year, something like that? So we don't have huge returns in mind, but we do have in mind never losing anything.
Finally, at top 1, invest in businesses you can understand.
There's all kinds of things I don't understand, but fortunately, there's enough I do understand. And you got this big, wide world out there. Almost every company's publicly owned, so you got all American business practically available to you. Now, to start with, it doesn't make sense to go with things that you think you can understand, but you can understand some things. I can understand this. I mean, you can understand this. Anybody can understand this. I mean, this is a product that basically hasn't been changed much. They've added the cherry, since 1886 or whatever it was. And it's a simple business. It's not an easy business. I don't want a business that's easy for competitors. So I want a business with a moat around it. I want a very valuable castle in the middle. I want the duke who's in charge of that castle to be honest and hardworking and able. And then I want a big moat around the castle. And that moat can be various things. The moat in a business like our auto insurance business at GEICO is low cost. I mean, people have to buy auto insurance. So everybody's going to have one auto insurance policy per car, basically. I can't sell them 20, but they have to buy one. What are they going to buy it on? They're going to buy it on based on service and cost. Most people will assume the service is fairly identical among companies or close enough. So they're going to do it on cost. So I got to be the low-cost producer. That's my moat. To the extent my costs get further lower than the other guy, I've thrown a couple of sharks into the moat. But all the time, if you've got a wonderful castle, there are people out there who are going to try and attack it and take it away from you. And I want a castle that I can understand, but I want a castle with a moat around it. 30 years ago, Eastman Kodak's moat was just as wide as Coca-Cola's moat. I mean, if you were going to take a picture of your 6-month-old baby, and you're going to want to look at that picture 20 years from now, and you're going to want to look at it 50 years from now, and you're never going to get a chance. I mean, you're not a professional photographer so that you can evaluate what's going to look good 20 or 50 years ago. What is in your mind about that photography company is what counts, because they are promising you that the picture you take today is going to be terrific to look at 20 or 30 or 50 years from now about something that's very important to you, maybe your own child or whatever it may be. Well, Kodak had that in spades 30 years ago. They owned that. They had what I call share of mind. Forget about share of market, share of mind. They had something in everybody's mind around the country, around the world, with a little yellow box and everything, that said Kodak is the best. That's priceless. They've lost some of that. They haven't lost it all, and not due to George Fisher, who runs it. George is doing a great job. But they let that moat narrow. They let Fuji come and start narrowing the moat in various ways. They let them get into the Olympics and take away that special aspect. Only Kodak was fit to photograph the Olympics. So Fuji gets there, and immediately in people's minds, Fuji becomes more on a parity with Kodak. You haven't seen that with Coke. Coke's moat is wider now than it was 30 years ago. You can't see the moat day by day, but every time the infrastructure gets built in some country that isn't yet profitable for Coke, but will be 20 years from now, the moat is widening a little bit. Things are all the time changing that moat in one direction or the other. 10 years from now, you can see the difference. Our managers of the businesses we run, I've got one message to them, which is to widen the moat. And we want to throw crocodiles and sharks and everything else, gators, I guess, to keep away competitors. And that comes about through service, it comes about through quality of product, it comes about through cost, it comes about sometimes through patents, it comes about through real estate location. So that's the business I'm looking for. Now, what kind of businesses am I going to find like that? Well, I'm going to find them in simple products, because I'm not going to be able to figure out what the moat's going to look like for Oracle or Lotus or Microsoft 10 years from now. I mean, Gates is the best businessman I've ever run into, and they've got a hell of a position. But I really don't know what that business is going to look like 10 years from now. And I certainly don't know what his competitors' businesses are going to look like 10 years from now. Now, I'll name one I don't own. I know what the chewing gum business is going to look like from 10 years from now. I mean, the internet is not going to change how we chew gum. And nothing much else is going to change how we chew gum. And then are there going to be lots of new products? Is it really, our spearmint and juicy fruit and all those going to evaporate? So it isn't going to happen. You give me $1 billion and tell me to go in the chewing gum business and try and make a real dent in Wrigley's, I can't do it. And that's the way I think about business. I say to myself, give me $1 billion and how much can I hurt the guy? Give me $10 billion. Give me $10 billion and how much can I hurt Coca-Cola around the world? I can't do it. Well, those are good businesses. So I want a simple business, easy to understand, great economics now, honest and able management. Then I can see about, in a general way, where they're going to be 10 years from now. And if I can't see where they're going to be 10 years from now, I don't want to buy it. Basically, I don't want to buy any stock where if they close the New York Stock Exchange tomorrow for 5 years, I won't be happy owning it. I buy a farm, and I don't get a quote on it for 5 years, and I'm happy if the farm does okay. I buy an apartment house, don't get a quote on it for 5 years, I'm happy if the apartment house produces the returns that I expect. But people buy a stock, and they look at the price the next morning, and they decide whether they're doing well or not doing well. It's crazy, because they're buying a piece of a business. That's what Graham, the most fundamental part of what he taught me. You're not buying a stock, you're buying a part ownership in a business. You will do well if the business does well, and if you didn't pay a totally silly price. And that's what it's all about.
Did you enjoy the video? Let us know by smashing the like button and subscribing for more content about Warren Buffett. While you're here, you can check out more Warren Buffett videos, or you can check out Elon Musk, another brilliant individual. Thanks for watching, and make sure to keep this investing tips a secret.